Joining us right now, Oxbow Advisors Managing Partner Ted Oakley. Ted, good to see you. Thanks so much for joining us.
Hi, Maria.
Here we are, right ahead of the third quarter earnings reporting season, a market that is near record highs. What do you make of the market's run-up? Would you put new money to work here?
Not right here. Maria, the Dow is really camouflaging what's going on in the rest of the market. If you look at the Russell 2000 in the last few weeks, the financials, we have more new lows and new highs. There's a lot of things underneath that you can't see, and the Dow is really only 30 stocks, so you get that here and the rest of the market down here.
Ted, it's Kevin Kelly. One of the interesting things that's happened is that obviously the Fed raised rates last week. We're anticipating a December rate hike. What do you think about financials? I mean, given the fact that financials have actually come down, and it seems to be the perfect environment for them with the economy doing so well, rates are going up. How should we be thinking about financials in this market?
Well, Kevin, I think what the financials are telling you is that if you look at the long bond and you look at financials, you'll see the market's trying to tell you, I think, that the Fed is probably off the mark here over the next 18 months. And that's not the case with, I know everybody thinks the Fed's giving them basically the runway of what's going to happen through 2020. But in the real world, it doesn't happen that way. And we feel like that what's really going to happen will be a little different than what the Fed thinks is happening. And that's why financials and the long bond are not actually going along with it.
So just to be clear, you think the Fed is going to slow down the interest rate increases? I mean, Jay Powell spoke in Boston yesterday. He said that the tax cuts and the spending increases recently may have hobbled the Fed's response to any coming downturn. What do you mean that the Fed is not, the markets are not seeing what the Fed is doing?
Well, Maria, I've been in this business a long time, and you don't make any money following the Fed. They typically are late, and they look backwards.
I see.
And so we really feel like what will happen is, I know they've got this layout through 2020, but all you have to do is have some weakness for a quarter, and we think they cut and run, and we really feel that will happen somewhere in the first quarter next year. That it'll be slower than what they think it'll be.
I gotcha. All right, James Freeman.
Okay, but Ted, along those lines, you seem to have maybe a more humble Fed, kind of saying they want to get less into the business of issuing forward guidance in the future. I mean, is this potentially a positive for investors long term?
Well, I don't think so. I think you've always had a Fed that they take the data right now and they look backwards. It's very hard for them to tell you what should happen. If you look right now, for example, autos, housing, a lot of store sales, a lot of things are slower than they probably pretend. The only thing that's been great in here has been the stock market.
Yeah, it has been a great stock market. I mean, we're looking at the 102nd record close for the Dow since Election Day in November 2016. So what do you think can derail this run that we've been on?
Well, we think they're at the end of the cycle. What happens at the end of the cycle is that profit margins start to come down, and then profits start to come down, and all of the extremely rosy estimates for the fourth quarter and the first quarter of 19, they have to adjust them. And we feel like that's that'll be happening here in the next 6 months.
So how significant, I mean, you say you won't put new money to work here. Are you expecting a significant downturn then in the stock market?
Well, I think you get something adjustment. I mean, everything's expensive right now. Interestingly enough, we see so many companies selling at high multiples, very, very high multiples. And it's not just in one sector, but it's across the board. So for us, it's not like we're out of the market, but we have more cash now than we've had in probably 3 or 4 years.
Ted, I got to come back to this Fed issue, because we went through this period where during QE and all these other experiments after the financial crisis, the Fed kept overestimating how good the economy was going to be. Finally, we've gotten to a point where they actually underestimated. But you think the problem is they're still overestimating too much, or what? It seems like they're sort of on the way to solving this problem.
Yeah, 4 rate cuts seems excessive to me. I mean, I don't know.
Well, if you think about it and what they say the normalized rates will be through 2020, we just don't think they'll ever get there. I mean, we have $71 trillion of public and private debt in this country. You put 2 or 3 points on it and see where you end up. And we just don't think they've got the wherewithal to get it through to the end. I mean, I'm saying they can't do it in December, but the thing about that is you get this much debt, and what happens is you put a few interest rate points on it, and you'll see where it ends up. I mean, just look at the housing market and the mortgage market right now.
Yeah,
it's having a big impact.
Yeah, I meant 4 rate hikes, obviously.
Okay, but yes, absolutely, it's going to be tough for the government to fund itself when it finally has to pay normal interest rates. But the Fed can't resist that indefinitely, can it? I mean, they can't just choose not to acknowledge if it's time for a rate hike and prices are rising.
Well, they can, but we think what happens is if you look at the number one driver of what's been pushing the consumer, it's been the stock market. So if you have the market settle down the next 6 months,
what about the tax
they'll
cuts?
Probably settle down too.
What about the tax
cuts? Well, I think that's been okay for corporations if you look at it, Maria, but they've used the money to buy back stock. I mean, you can look around. They haven't given great raises in this thing.
Well, most income levels got a tax cut, and they did double the standard deduction.
They did, but you're not seeing it. Look at consumer confidence, and you look at that. You go back 30 years.
Yeah.
When it's this high, you don't get big moves in the market. I mean, statistically, it's right there.
What do you think is going to be the most vulnerable? I mean, is there anywhere to hide in this sell-off that you're expecting, or this disruption, as you called it?
Well, I'll just give you a sneak peek. Okay, look at the FANG stocks, and I'll do it real quickly. The FANG stocks, for example, are losing momentum. They're not hitting new highs here with the Dow. Now, I understand they have had a good year, but you look at the last month or so, and they're not hitting new highs. It gives you a little bit of an idea of what's happening.
Maybe that's why Tencent not doing so well this morning overseas with its IPO. I assume you would not be buying into Tencent right now.
Well, I wouldn't, but if you look at Tencent, JD, Baidu, those companies, relative to counter companies that are in the U.S., they'll start getting in the buy range fairly soon.
All right. Wow. Good analysis. Ted, great to see you. Thanks so much.
Thank you, Maria.
Ted Oakley.